welcome back to another episode of With Sonar. I'm Luke, joined by Tony and Tanner. We've got a great lineup for us today. The back half of May, getting close to the end of Q2, but right in the middle before we get there, we've got some exciting things happening. Future supply chain, as we all know, just under a month away now. Yeah. Just under a month away. Going to be a great time. A lot of folks coming there. I'm excited for this event. I might get a little heat for this, but so we've got two events that we do each year, F3, Future Freight Festival, and Future Supply Chain. I think I prefer Future Supply Chain. It's just a much more diverse audience and event because it really focuses on the broad supply chain as opposed to Future Freight Festival, heavy freight. If you're into freight, F3 is where you want to be, but like the entire supply chain, Future Supply Chain it's it. Do you guys have a preference?
I don't have a preference. I'm looking at as the registrations flow across my desk, seeing some of the companies that are attending, it's going to be like the who's who of freight and supply chain. So
really well.
Yeah, we definitely made a shift compared to the last event in November we had, which was awesome in Chattanooga. I think we got a lot of really good feedback, and especially now we're adding some really big names. It's going to be a lot of fun, guys.
It's going to be a lot of fun. Yeah, I mean, you've got speakers that are coming too from Coca-Cola, right? I mean, you've got speakers from some of the biggest, real estate companies in the world. I mean, it's going to be exciting, and a lot of new technology that's going to be there as well. That's obviously emphasis in the freight world, but also broader supply chain as well. So definitely an exciting event.
And rumor on the street is we're going to have a couple episodes with Sonar.
Yes, we will. Some very special guests on With Sonar as well that I would love to tell you about, but I can't just yet because that'll ruin the surprise. Anyways, so we'll see you there. That's June 21st, 22nd. Going to be a great event, Cleveland, Ohio. And of course, after hours party at the Rock and Roll Center Hall of Fame. So always exciting there. But we'll come back to that more later. Folks, we're in the back half of Q2 right now. Lots been happening. We've seen some more consolidations, a little bit of M&A activity. Not nearly as big as Knight Swift, U.S. Express, but some things are happening. And Tony, let me just ask you, where are we in the freight market right now? Like, what is seasonally normal around this time? And then are we deviating from it at all or going back to it?
Yeah, I mean, what's seasonal? I mean, May, typically the back half of May is stronger than the beginning of May. You see around Memorial Day, you start to see a pickup, right? That summer shipping season. I mean, if you think it's not the peak season, but arguably the second strongest period for at least truckload movements is between Memorial Day and July 4th. And so we're approaching that. Blitz Week moved up, right? It was in May, so that helped firm up the market a little. I mean, you saw rates kind of pick up a little steam last week. Projections followed suit. Volume levels have picked up a little steam. So, I mean, seasonally, you're kind of right where you would expect to be, right? We're about to head into what would be the peak produce season. I think the question is, how peaky is that produce season? Yeah. Like, how strong is it? Because you had floods in California that really affected planting seasons. It'll ultimately affect harvest too and timing. So we'll see how that plays out. But right now, I mean, everything looks fairly seasonal. I mean, you start looking at ocean data, it's following pre-COVID trends. Yeah. So, I mean, right now, it's acting kind of how you would expect, right? I think the drop at the beginning of May was kind of unexpected, especially when you factor in what the forecast said, that we would see some movement in April, the end of April and upwards in May. We saw it actually decline, but we rebounded, right? So I think overall, the market's fairly seasonal, but it's not very strong, I guess, is the other factor in that.
Tanner, we've seen rates now kind of bump up about 3.5% over the last week and a half. Is that something to be excited about, or do we think it's a blip?
Yeah, I think it's a blip. Okay. We've been talking about last few weeks about we're going to get a lull, right? We're going to get a long time kind of lull in the spot market, and I think, Tony, what you mentioned about Blitz Week, a little bit of seasonality. We had that 20-day floor that we held right at about $222 a mile, late April leading into May, and then we all kind of got shocked by this drastic move down again, about another 10 cents. So yeah, Blitz Week, we've recovered. We're right back at that 222, 221 level.
Let's put it up on the screen. Folks can see.
I think we're going to float here for quite a while. I think, yes, with seasonality, we're going to be looking at ocean data a little bit later on in the show. Got a little bit of demand picking up there. But in my opinion, I think we're going to float right around this 220 to 225 range.
Yeah, no, absolutely. Yeah, and there it is right there for folks if you haven't been able to see it yet. So Blue line is where we are kind of basically over the last year. Are we able to get it on the main screen? Let's go ahead and pop it up. There it is. So yeah, just like you said, there's that 20-day floor that you called out there where we hung out for a while. And like you said, we've come right back to it. Which, by the way, I think our forecast was anticipating a little bit of a bump around here as well.
Yeah, I mean, you got Memorial Day, right? This is a time frame where you, from the shipper's perspective, you want to get stuff off your docks, right?
Right.
You want to make sure it's where it needs to be for this summer, because I mean, Memorial Day is kind of that unofficial start to the summer season. That's one thing, and then you do typically have capacity constraints around holidays, right? You'll see drivers. I think the question this year is like, how much capacity comes off the road? Like, can they afford to do that?
Yeah.
We talked about it earlier in the year, it was really around the holidays. Like, you saw arguably more, or the Christmas, New Year's holiday, you saw more capacity come off. You saw rates really aggressively move higher during that period. But we were still coming off highs, right? The market was still, I mean, you look pre-holiday, I mean, spot rates were still what, $260 a mile or $250, $260? We've come down significantly. I mean, we're talking 30 cents a mile. These carriers were flush with cash still. They could afford to stay off the road, and the ones that stayed out made money. Can they do that now? I think that's the question. I mean, from the peak to now, what is it, down almost 22%? So, I mean, you're talking a pretty
Just
dramatic...
since the start of the year to date, and we were already down quite a bit.
Yeah, so you're talking dramatic declines overall, 50, 60 cents a mile.
Yeah.
Can you afford to take this time off, I guess, is the question that's going to be asked.
Yeah, and there's always a back half to the statement, too. It's like, okay, if revenue or driver pay is falling, what are costs doing? And the interesting thing is basically looking at the same chart, if you put it against fuel is actually still 14% higher than where we were compared to the peak. So costs have not, insurance is still high, truck payments are still high, and fuel, which is arguably a driver's biggest expense that they look at that hits them on a daily basis, and it's even increased.
Yeah. So all around increase. So rates are still very depressed. Do we expect this to continue to bump through Memorial Day, or do we think we'll hang out around this 20-day floor range?
Yeah, I mean, I think the forecast kind of shows getting up to like 227. So I mean, you maybe have a
teeny bit above.
Yeah. So I mean, it's not much, but then it kind of flatlines in June.
Yeah.
So I mean, it could be anywhere between 221 and 230. I think anywhere in that range is about where we'll hover. I would say for the next. What it looks like is at least the next 4 weeks is getting in that range.
Okay. No, that makes sense. That's good. So in essence, just to summarize right now, so rates still down about 22% year to date. However, we've seen a little bit of a bump. Most of that is mostly just due to we kind of get into the end of the month, the holiday. We're blipping really back up to that 20-day range, maybe a hair above it. Not something to get too excited about going forward. It's really just a blip. But if nothing else, we found a short-term bottom that we're hanging out in.
At least that's how it appears, right? So.
Good. Well, that's good. Still a lot of room. I think we don't have it on the screen, but on the contract side, I think we all know still a lot of room probably for the contract market to come down since the spread is still pretty high. So if spot rates do hold this level, we should expect contract rates to fall further. What I want to highlight, though, too, is we've talked a lot about demand, right? And demand is one of the biggest leading indicators for where the freight markets go, right? Demand obviously increases extensively, right? That'll eat away at that available capacity. We should see rates rise and vice versa. So, and one of the biggest indicators that we look at for future truckload demand is ocean imports. And we've been looking at our ocean import data for a while. And we've seen a little bit of a bump. Again, to your point, it might be a little bit of a blip, but I think it's good to highlight. So let's go ahead and throw up year to date. We're going to look at some of the ocean bookings that we've seen here. And I think this is exciting. If nothing else, we're not falling anymore, right? I mean, that's kind of what it is, right? And I think we can't go up until we find a bottom. And what's interesting here is this bottom hit in the middle of February, which is about when we would expect it to hit, with previous, Lunar New Year's. But I mean, we're at a year-to-date high. We're at a year-to-date high, and I think that says something that we're pushing higher. What I'm curious about, though, I guess, Tanner, let me ask you this, or Tony, is we're seeing this bump in bookings, right? So future, shipments coming to the U.S. Is this in relation to Memorial Day? Because that would take too long to get here. So what is this bump like? Why is it happening now? Why didn't it happen, I guess, earlier?
I mean, I think you start factoring in, you look at the time. I mean, back to school is one of them, right? If you think that's one of the next major, I don't even say major bumps to spending or boost to spending, but it is a time frame that does move freight. It's not a very prolonged bump, but I mean that you start factoring in, okay, this is now, you're talking what, 20, I think it's a 20-day, 25, 28-day average transit time. There's really no delays. So you're talking a month, 4 to 5 weeks. So this is putting you early July hitting the shores. I mean, that gives you time to get it on the shelves for that back to school season. If you think that's really end of July, the first maybe week or two in August. And I think that's part of this bump. I don't know if it's all of it, but I think it does play some factor.
Yeah, I think another part to consider is maybe kind of the over-exaggeration of what interest rates would do. I think a lot of retailers in early February, they were worried about what the Fed was going to do, so they under-ordered, expecting a lot of that inventory to kind of peel out. And so since retail spend has still remained high, I think they were expecting it to drop a lot further than it has, right? Retail spend has only been dropping, I think the last report is about $900 billion, I think is what, not by much, right? So I think maybe it was an over-exaggeration that they stopped ordering. And so now I think we're seeing that backfill of inventory. Warehouse levels are kind of starting to level off, pick up a little bit. So I agree with you. I think it's seasonality moving to the summer, but also thought that February dip that we had was a little bit of an over-exaggeration.
Yeah. And if we back the chart up a little bit too, I think we'll see that it's not something that's, it's bumped up, but it's really back to 2019 levels around this time. So here, let's go ahead and throw this up on the screen. So really, the 2019 levels that you see here going back, we're mostly in line with that. And we see a bump kind of running up into July. And then it looks like it dips after July, which is fairly seasonal. Even during the pandemic, while it did a lot of craziness, if you look at 2021 July, it dipped as well.
Yeah, I mean, it really is leading into May, right? Henry's article was the end of May last year, leading into it. Things were still kind of ticking a little higher, and then it just, the bottom fell out.
Right.
Kind of it's what happened at 19. It happened in 20 was an anomaly because everything was that was when you were reopening and everything kind of surged back.
Correct.
But 21, you see same thing, ticking up into May, and then it drops out in June. So I do think it's more seasonal than it is anything. But like you alluded to, it's not going down anymore. I think that's if there's a positive sign, that number hasn't completely collapsed again. And as you said, maybe February was an over-exaggeration or under, they were expecting things to be worse, and maybe they haven't been as bad. I think there's some maybe headwinds coming, but I mean, if you look at the largest retailers, some of them have made headway on their inventory levels. Right. But they haven't all gotten back.
It's still fairly bloated.
Yeah. So that's where I think you don't see maybe a massive surge, but you do see some of these retailers have made progress and are having to backfill, but they're still elevated overall.
And there's a few things that absolutely could make this data set start to come back down, right? If inflation continues to remain high, right? If the student loan program doesn't go through and people have to get back to paying those, that's going to take a lot of disposable income out of the market. So there are definitely, as you mentioned, a few headwinds that could make this data set trend in the opposite direction.
Yeah, could be a short-term lull. Okay, so I guess along that note, because we're always fun to predict, kind of put your best crystal ball forward, if you will. Where do we expect this chart, the ocean volume, where do we expect it to finish the summer with? So finish by September, right? Because the reason why we look at that, right, if it's not being booked by the end of September, it's probably not going to be here for the holiday season. So where do we expect this? Do we expect it to be in line with where it is today, higher or lower? Let's start there.
I'll say lower than where it is now. Yeah.
Where it is now? What about you, dude?
I'm going to say higher.
Higher than it is
I'll
now.
go the opposite.
Okay.
The reason is because
it.
I think eventually when we get towards the end of the market cycle and we do get to about that 20-cent split that we've talked a bunch, I think if we do have a soft landing, which they've done pretty well so far. I'd say they've done pretty good. Right? If we get to a soft landing and maybe student loan debt does get let go or accused and people don't have to pay that, I think you might get a little bit of a demand spike. And so, like I said, don't call me bullish towards the end of the year, but it definitely is possible if this supposedly soft landing does go well.
So you're betting on them either suspending or delaying potential payments?
Suspending them and just getting rid of the loans completely so that you don't have to.
How much in student loans do we have? What's out there right now? 1.2?
Do you know the number?
Hold on, wait, I'll look it up. I got it.
I don't know. It's remarkably high. And it's, I guess the headwind part, what I would think lower.
1.78 trillion with a T.
Yeah, I mean, it's a massive amount. I guess my concern would be those, so I think of it in a few ways. And not everybody carries student loans. So that's one factor. So it's not going to affect everyone. Mm-hmm. But typically it affects your younger cohort.
Some people are already in school with a student loan, so they're not spending a lot anyway.
Yeah, so you've got, say, call it the people that are between 40 and 22, those ones that are just coming out and making their first real paychecks. Those are the ones that typically carry the debt, but they're also the ones that spend the most money, right? If you take, especially those that have come out and have never had to make the payment, right? Say they graduated in 2020 and these things have been suspended the whole time. Well, now it's going to come due. Something's going to come due. Average payment's around $400. They've never actually had to pay that number. Like that $400 can go, like that's an instant, it's out of your discretionary spending, right? So that you've been spending. How does that impact it? Like if it comes back in the way that kind of like it could, like it feels like that $400 can go a long way, right? I mean, you saw stimulus. What were those $1,200 checks or something like that? Like those went a long way. Well, you're taking $400 out. It means 3 months basically over the same as that stimulus. And you saw how demand reacted when stimulus came out. How does demand react when now instead of stimulating the economy, you're pulling an extra, say, $400 out of people's discretionary income of those that do carry student loans?
Right.
That's the only one that it's really hard to predict because you don't really know exactly how it's going to happen because it's one of those
And when does that come back?
So it's supposed to be 60 days after they rule on, if the Supreme Court rules on it, or it's 60 days after it expires, which would be June 30th would be the expiration.
Mm-hmm. So 60 days after that.
Which is September 1st. So it's right there at that end of or beginning of September.
So assuming all that goes to plan, let's say
right at the basically start of the fourth quarter, you're taking out.
When would we feel it? So if September 1st, right, they kick back in, right, they got to start making those payments. Are we going to, it probably takes, about a month to start feeling it?
I would think so. I mean, somewhere in that range, right? Yeah. Month. I would say look at fourth quarter spending as a whole and how that is impacted. That'll be one of the interesting tells.
Yeah, and relating it back to kind of the U.S. domestic truckload market is that contractor rates are falling at a rate that we would get to that 20-cent spread around the end of this year, right? And so if that ocean, depending on what the ocean market does, the reason I think is possibly getting bullish and moving into 2024 is that if you do get that 20-cent split, that means we're at the end of the market cycle. Yeah. If capacity continues to leave the market by the time we get to January of 24, and then all of a sudden you've got this inbound ocean demand from ordering in Q4, think that's where you might get a little bit of a reversal. So it's going to be interesting. Yeah, $400, that's a lot of money to take out of discretionary spending per month.
Especially if you haven't budgeted for it. I think that's the big one is if you've just spent, I mean, you have to remember how many people live paycheck to paycheck still. I mean, it is way more than you think it is. Mm-hmm. And then you add in another $400 expense that's coming out of $400 that they've been spending already.
Well, and it's not that they've been saving it because savings rates haven't gone up. It's the fact that they went out and got a car payment or they've been blowing that $400 a month. It's not like people are just have $400
or added.
They went and added something to their bills.
Yeah, exactly. Or mortgage or, right? I think I saw average mortgage rate now with interest rates is $2,700. And the spread between
rent
and mortgage is the widest it's ever been.
Rent was, I think, $1,700 or $1,800. It's almost $1,000 spread.
$1,100 split between paying for a mortgage and paying for rent.
Yep. So it'll be interesting to see how if that's impacted in any way.
Yeah. One thing, last chart we're going to show here is ocean rates, because I think this one paints a really interesting picture for how I think the demand is flooding. So this is year-to-date ocean container rates from China to North America West Coast, right? So this is arguably the biggest trade lane that we have, at least in terms of volume. So this measures the daily rate on the lane. So right now we're sitting at about $1,300 a container. And notice that, and I think you're right. I think this is where that ocean demand, it's a quick blip. I lean on you here because we saw that bump heading into mid-April, right? That big bump where we went from $1,000 a container all the way up to, I think, about $1,700. So 70% increase in about 2 or 3 days. And then now we're kind of trickling back down again, meaning I think that demand's probably short-lived.
Yeah, I mean, I think one of the things to remember on the ocean side is, 9 carriers control 90% of the market or something like that. So like they can
pull capacity off.
They make it's easier for them to pull capacity out of the market and try to move rates, right? Yeah. They can try to pass general rate increases, things like that. They pull capacity off. They just slow down transit times, right? They blank sailing. So, I mean, like for them, it's a lot easier to try to control what's going on in the market from a spot rate perspective. And I think that's part of what you see here. And I think that's also why you're seeing some of a blip, like some of that increase too.
Yeah.
And what's crazy is that, we're looking at a short-term pop here of like $700. What's even gnarly is if you go back looking at 3 or 4 year chart, this lane was moving for like $20,000+.
Yeah.
So it's like, I don't know what $700 does for them. Like, it looks like they went on strike and said, okay, hey, we're lifting 700, but
70% increase in 3 days.
But you're still down from like $22,000 at the peak of COVID for this lane.
You're down like 93%.
A lot.
Right now, after the pump, you're down 93%.
Yeah, I would not want to be an ocean carrier that has to answer to their shareholders. But I mean, I think this goes into some of Craig's talking points about freight as a commodity. Yeah. Like it truly is a commodity, right? Like it has these dramatic swings similar to commodity pricing, right? Look at oil and the swings that those have. So I think it's one of those. This is just it shows that it kind of is. I mean, it really...
100% it is.
So it's...
100% it is. Yeah. Anybody doesn't think it's a commodity they're not playing in the same game. I mean, it's, right? Supply and demand dictate essentially everything, right? Service is relevant up to a point.
Yeah.
But we've seen service get thrown out the window so many times, right?
Yeah.
Relationships have gotten thrown out the window so many times. And you might be, if you're watching this, you might be the exception, right? But when we look at the entire market, the market really has, when demand went too crazy, right? All those contract rates thrown out the window, rebids, go to the spot market, right? Now the flip side's happening. All those contracts are being renegotiated lower.
Yeah, I think anecdotally, some of the things I've heard was carriers came back to shipper and broker partners in Q3 of last year, knowing rates were coming down, trying to go rebid those contracts lower then. And so they kind of maintain this that little bit where we've seen contract rates fall this year, like they haven't felt that yet. Like those are going to come to bid here before too long. And when those do, it's like, we'll see what actually happens. But I think that can go into this further acceleration of downward movement on contract rates.
Yeah, this week has been 12 months since the peak of the contracted market. Yep. So on May 22nd, so Monday, 12 months ago, was the peak of the contracted line haul average at $2.97. So if you're a carrier that's been locked into a 12-month contract at $2.97, in order for you to maintain that business today, if you want to re-sign that contract, you're making about 54 cents less per mile on that contract.
That's tough.
And that's the reason they've been able to hold on to that revenue, because they've been locked in that contract. So, how big is it for a carrier to go from making 50 cents more to now just on a flip of a dime when these contracts go into effect, now 54 cents less?
What's that do to that OR?
That hurts revenue.
Hurt it. Yeah, absolutely. And expenses are up, right? Like it's not like they've come down. Fuel's come down from that, but it's not in any meaningful way. Like it's not 54 cents a mile, right?
Yep, and you're not right. We only have a month and a week left, right? 5 weeks left in order for the Q2 report to hit in Q3, but I think it's definitely going to affect them in Q3. So I think the report that you get in October, November for Q3, that's the report that's going to be really, really bad for asset base.
Yeah, it sure feels that way.
Be interested to see how it plays out. Well, folks, that's all we have time for today. Remember, Future Supply Chain, if you're able to be there, we'll be there. That's June 21st and 22nd in Cleveland, Ohio. In the meantime, we'll see you next week. Have a fantastic rest of your day. And follow us on TikTok, Twitter, and LinkedIn for more updates throughout the week. Have a good day.